Good morning, everyone. This is Darren Scheringer from Yorkville Capital. Thank you for joining us for our quarterly webinar. With me on the call today are Jim Hugg, Len Edelstein, and Will Hershey is moderating and will be handling questions at the end of the call. For questions, please, if you are online on the webinar, on the top left, you'll see a chat box. Enter your questions. We will address as many as we can at the end of the conference call, and if we can and we're so good, we'll try to address some of them on the fly, but I can't promise you that level of excellence. The title for our quarterly call is U.S. Energy Production Growth Benefits, MLPs. And as we've stated many times before, MLPs are a structure. What you're investing in is essential U.S. energy infrastructure, a hard assets, and think of pipelines generally speaking. So MLPs are the energy toll roads, and instead of roads, they're pipelines. So they transport energy, and as a road, what's important for roads is volume. And we've all been in traffic jams before, and when we have too much volume, everything slows down, traffic slows down. So there's more capacity that needs to be transported. And with production growth in energy, it means more capacity needs to be transported across the U.S. energy highway. And that's ultimately good for MLPs, the pipeline operators who are in the business of transporting energy from point A to point B. So what we're experiencing in the U.S. right now, and if many of you have heard the term the U.S. energy revolution, which is, in our opinion, very accurate, what's happening in the United States right now, we're experiencing tremendous growth in volumes. And that means a tremendous growth in energy that needs to be transported around the U.S. and increasingly from the U.S. across the globe. And we see tremendous opportunities going forward to participate in the transportation of energy from the U.S. to Europe and to Asia. So as we look at this first slide here, U.S. oil production is at its highest level in 24 years. And Jim, you've been researching and investing in MLPs now for over 20 years. How does this compare to what you've experienced in most of your investment career in this space?
Well, my good friend and partner Lenny and I have been researching and investing in MLPs, as Darren said, for over 20 years, and during this period of time, there's never been up until recently, there's never been an increase in the production of oil and natural gas. And in spite of that, and this is the key to investing in MLPs, there has been a continued increase in the market capitalization of MLPs, and of course what drives that is an increase in distributable cash flow, which translates into increasing distributions. And the reason why you have the increase in distributable cash flow and distribution is that it's made up, of course, the shortfall is made up by imports, and you still need the infrastructure, and the infrastructure you need because of changing demographics, people moving from the northeast to, the southeast or to the southwest, and there are changes in where the oil and gas deposits are. And of course, that's become particularly important in the last several years, where you now have names that a few years ago most of the people, including myself, had never heard of, the Bakken or the Marcellus, but there are names now that I'm sure most people or everyone on this call are familiar with. So this is a very exciting situation, because if you felt things were good in the past, now that we have actually have turned around and now there's increases in the amount of oil and gas we're producing, this presents a very bullish environment for energy in general and specifically for MLPs.
Well, thank you, Jim. And I'm going to touch on a number of statistics on this slide, and I'll be careful because I know too many numbers on a conference call ends up losing people. Again, the backdrop is, from a macro perspective, in over 20 years, we as a firm have not seen the support from a macroeconomic environment, meaning increasing production levels. Greater production volumes means the need for more U.S. energy infrastructure. And Morgan Stanley published a study, or it was done by an independent third party, that estimated the need for essential U.S. energy infrastructure over the next 12 years, investment in it, would be over $1 trillion. So clearly that is growth in quantifying what the need for future infrastructure means, and that directly translates into growing distributions, the investment thesis behind MLPs. So on this slide now, U.S. annual production, the first one in the title here, production is at its highest level in 24 years, which is incredible, meaning we have production growth from a period of over 20 years where we had production declines in the United States. And this turnaround has happened just over from the mid-2000s going forward. The other statistic now is this 15% increase in production from 2012 into 2013. This is the fastest growth in volumes, so the amount of oil the U.S. has produced since 1940, before the Second World War. That's an incredible statistic. Where is this growth coming from? And Jim mentioned it earlier. There's new areas of production, which means even more infrastructure needs to be built out, and we've coined the phrase these new energy frontiers. The unconventional shale plays of Texas and North Dakota contributed 83% of the growth in volumes between 2012 and 2013. And that means, again, that's where the new energy infrastructure needs to be built to support this volume growth. The next slide in the presentation touches on an area that we see as a new growth area, a new opportunity for us as investors in the MLP asset class, and that's the exporting of liquefied natural gas. And what does the exporting of LNG mean for the United States? Well, currently there are a number of what they're called terminals that will ultimately end up exporting LNG to Europe and to ultimately Asia. These terminals that are applying for production permits ultimately, that means they can produce a certain amount of LNG to export. If you look at the total number of applications right now with FERC, it would equal a growth in demand, current demand in U.S. Natural gas consumption of 21% if all of these applications are approved. Now, Len has been investing in Cheniere, which will be the first company to export. So Len, why don't you tell us what it means, when they'll begin exporting, and what it means to distribution growth going forward?
Cheniere, which has got its export terminal in southern Louisiana on the Gulf, expects to be exporting in the second half of next year. In other words, about a year from now. And the way they and the others who are applying for permits have structured their export contracts is the following. They have contracted with major international firms like British Gas, Korea Gas, largest EDF, which is the largest French outfit, largest Italian gas company, and the contracts specify take or pay, which means these are 20-year contracts where the contracting party must pay the specific sums for the quantities they've contracted for, whether or not they accept them. This is a guarantee that Cheniere will have profits for at least the next 20 years. In addition, Cheniere, which has been around for a long time, started out as an import terminal, and obviously we didn't need it starting a number of years back, has been paying $1.70 a year distribution. There are some expectations, which I think are not outrageous, that within 2 or 3 years that $1.70 could increase to $2.50 or $3, to show you the incredible potential of this situation. They're also building another export terminal in Texas as well.
Thank you.
All in all, this, you're welcome.
No, you go on, please finish. This is
All in all, and these are not the only ones. There are others that are applying, and some are getting approval from the Federal Energy Regulatory Commission. We're also dealing with tankers being built specifically that exist already, and more being built specifically to carry the liquefied natural gas around the world. And this is another MLP sector that Jim especially has been involved in.
no.
So we're going to be exporting a lot of LNG, and the world is dying to get it. And obviously Europe needs it desperately because of the situation vis-a-vis the Russians.
No, absolutely, and the exportation of LNG opens up a brand new market for MLPs now in the transportation and the shipping opportunities that will come from essentially exporting no LNG to potentially over the next from 2015 second half through the next 7-8 years, increasing it by 21% of total demand. That's a lot of volume that's going to flow via ships to Europe and to Southeast and to Asia. So an opportunity that we're very interested in and looking to find investments in that space. So thank you, Len. We're looking at the next slide here. These two scores are really designed to help our clients and investors in the space in a snapshot understand what the overall quality of the asset class is. And we learned, these scores really came out of the lessons learned from the great financial crisis of 2008 into 2009. And if you look at Yorkville's portfolio during that period of time, on a price basis, it fell in line with the broader markets. But on a quality basis, which is the stability score, 100% of the names in our portfolio maintained or increased their distribution. So from a cash flow perspective, the cash flow was safe. And that's very important to our investors who are looking for stability of cash flow. And as fundamental analysts, this gives us the ability to look for MLPs that have the ability to maintain and increase their distributions in very bad market environments. So stability of distribution. So what the stability score shows is a score of 10 would mean 100% of all MLPs in the entire universe have maintained or increased their distribution across for the most recent quarter, measuring year-over-year growth. So a stability score of 9.7 means 97% of all publicly traded partnerships in this quarter maintained or increased their distribution. So stability is extremely important. We want to see broad-based quality across the asset class. The second score is, so stability is a measurement for quality. The second score is the Yorkville growth score. And this is what Jim mentioned, this was what Len mentioned. The primary reason in the investment thesis behind MLPs is distribution growth. Because distribution growth it provides really 4 primary benefits. Number one, it's protection against rising interest rates. And at some point, interest rates, we hope, are going to start to go back up. Number 2, distribution growth, it provides a hedge against inflation, meaning that over the next 10, 20, 30 years, as we start to have inflation, it preserves the purchasing power of your assets invested in MLPs. Number 3, MLPs that are growing their distributions ultimately are less likely to cut distributions. So it improves the stability score or the quality of distributions. And finally, number 4, distribution growth is what drives price appreciation. So if we've often stated this back of the envelope calculation, you look at your current income, which across the asset class is approximately 5%, and add your distribution growth rate, which year over year was 7.3%, and you add the two together, which takes you to 12%, is a good indication of what we think the future growth rate of MLPs will be. So the growth score at 7.3% was very healthy. In the second quarter across the asset class, we saw stability, quality. 97% of all MLPs maintained or increased their distributions, and the overall growth was 7.3%. And we'll compare and contrast this with the MLP core income strategy in a few minutes. The asset class comparison returns for the second quarter and for the year. As you can see, the alternative income asset classes of REITs, utilities, and MLPs are all having a very good 2014. The second quarter was actually a banner quarter for MLPs. The returns across the Yorkville Universe Index, which is again 100% of all master limited partnerships, so the most accurate benchmark to track the performance of the asset class, showed growth of 15.1% for the quarter. Year to date, MLPs, the entire universe is up almost 20%, 19.5%. It's the number one performing alternative asset class, but very close. I mean, utilities are doing fine at 18.7%, REITs at 16.3% for the year. Again, comparing that to the S&P 500, MLPs continue to deliver superior performance, almost for the quarter tripling the performance of the S&P 500, and for the year almost, well, at a minimum 2.5 times greater than the S&P 500. So the MLP trend of based on quality and growth of distributions continues to outperform the S&P 500 in 2014, which is a trend we've seen over multiple time periods over the past 14 years. The historical returns, it's just, we put this chart in here because it's just a reminder. Actually, Len really likes it. It's probably why we put it in. I'm just kidding. But it's just a reminder of the benefits of compounding and what it means to a client's portfolio over time. So, again, going back to 2000, and the reason we look at 2000 through 2014, it's really when the MLP asset class reached a maturity and the level where institutions could start to gain exposure to the asset class, meaning there were enough names and the market capitalization was large enough. So from 2000 through 2014, you can see the closest performance comparison is REITs, and they've produced half the returns basically of MLPs. And then moving down, when you start to compare utilities in the S&P 500, it's growth rates of 5x greater and above over utilities and the S&P 500. Our thesis there would be that's because of the quality of growth you've seen in not only the high levels of cash flow, but the growing cash flow that MLPs have been able to produce over this time frame, and looking forward, produced in the last quarter. And given the backdrop of volume increases, we believe, and as Jim stated earlier, have not seen a time frame where the macroeconomic thesis looks as bright for MLPs as it does currently. So asset class yield comparisons, MLPs, I mentioned it earlier, they're yielding 5% currently. That compares favorably. Your investors are getting income from MLPs, 5% versus 3.8% for REITs and 3.5% from utilities. I always found this interesting, and I probably mentioned it every call, that MLPs are delivering more income, but they're also delivering higher quality income, greater stability, and that's how we measure quality, and faster growing income historically than both of these asset classes. If it's higher quality and faster growth, why is it also delivering more? And I think over time, as more and more institutions get involved in the marketplace, that this spread between MLPs and REITs and utilities will start to narrow, and MLPs will start to trade more in line. the good news for investors in the asset class currently, that means multiple expansion. That means that will be another driver of price performance going forward outside of just the fundamental growth that we're going to see across the asset class. The next slide starts to bring us to, for our current investors, and we want to thank you here for your ongoing support. We're going to talk now on our flagship strategy, which is our MLP core income strategy. The current yield of our MLP core income strategy is 4.1%. So the first observation an investor will have is, well, why is it less than the overall asset class? MLPs, as you stated earlier, are yielding 5%, and you're only yielding 4.1%. Could you explain that? And I will on the next slide. If you look at the growth rate between the Yorkville MLP Universe Index, which again is the growth rate that I stated earlier, it's also our growth score. It measures the growth rate of 100% of all master limited partnerships. With 7.4% year over year in the second quarter, our strategy delivered 23% growth of distributions year over year. And again, that is the investment thesis behind the asset class. It's incredible that we're able to find partnerships that are producing cash-on-cash growth rates of 23% year over year. So Yorkville, in our strategy and how we differentiate ourselves in the marketplace, we really view MLPs, most investors come into them because of the high current yield. They like the 5% current income that they get from the asset class. We like the current income too, but what we really like, and this is our investment thesis I stated earlier, is the growth in distributions. Because we view MLPs as a total return strategy. This is an asset class that is in growth mode. The highest quality exposure to the asset class an investor can get are in MLPs that are growing fastest. And so not only are investors benefiting from higher quality, but faster growth ultimately drives price appreciation. So it's a better total return package. So the lower growth rates, lower distribution rates, or dividend yield that the core income strategy is producing is a direct result of the growth rate of distributions year over year. So at 23% growth rate, the rule of 72 states that in a little over 3.5 years, if this growth rate continued, distributions would be doubling. So the cash flow an investor receives from this portfolio would double over that period of time. So looking forward at our second quarter returns relative to the MLP universe, we delivered almost 20% in the second quarter, which is compares favorably to the broader universe. Again, our argument behind that would be the superior returns came out of superior distribution growth rate, superior fundamentals in our portfolio. On the next slide, we look at attribution of, and this is taking a look at the MLP sectors, and there are 10 distinct sectors that make up the MLP asset class or comprise the MLP asset class. A big portion of our attribution and performance in the second quarter came out of general partners, and we like general partners. We're happy to have conversations offline on that. They generally offer a superior growth profile to the LPs, and in this case, they perform well across our portfolio, delivering 8.5% of the return. Then energy services delivered 6% of the total return, and even our worst sectors, exploration and production and crude oil pipelines, were all produced positive returns in the second quarter of 2014. The next slide shows how our total return focus, our focus on delivering stability of distributions and growth of distributions has performed. And I was having a conversation this past week. All of Yorkville's investment strategies, they have two mandates, or two investment objectives. The first is stability of income. At a minimum, we want to ensure that the income we're receiving and that our portfolios are generating is safe. And what do we mean by safe? That there's a very low probability that any of the partnerships are going to cut their distribution. And in fact, that's the greatest sin that we can do as investors in MLP is invest in a partnership that cuts its distribution for a couple of reasons. One, the integrity of the income, the quality of the income the portfolio is producing has been compromised. And number two, when you look at MLPs, and we've published studies on this, that cut their distributions, you generally see a loss of principal, so price depreciation between 30 and 50% over the next 6 months. So not only do we lose income, the quality of our income, there's lower income, but we also lose capital, so we get price depreciation. So we want to ensure stability of distribution is our number one goal, and then on top of that, we're looking for distribution growth, clearly identifiable catalysts on a company or partnership by partnership basis. Where's the distribution growth going to come from going forward? Len laid out a nice case for Cheniere, where it's coming from, and overall, these two investment objectives have led to very nice looking return profile for our core income strategy over basically the 3 time frames we're looking at here. On a 3-year basis, annualized returns, we've delivered 37.4% on a gross basis per annum for our investors over the past 3 years. The 20.4% returns are what MLPs, is measured by the MLP universe, have returned. So greater than 50% positive returns in our strategy, given our focus on growth of distributions. If you look at the year-to-date numbers, we're up 28% versus 19% for the broader index. Again, a 50% outperformance year-to-date. And then on the quarter, I touched on that statistic earlier. Again, if you're uncertain and you think MLPs have had a good run, you think the market is getting expensive at this time, a quality upgrade is to move into MLPs that are growing faster, that show the fastest growing distribution growth, because it's going to provide you with the greatest amount of security and income and the best protection against rising interest rates at some point. So these are the historical returns of our strategy, and in the final slide, I'm going to open it up to Q&A at this point, is we like to believe our MLP core income strategy, with a focus on stability of distributions and clearly identifiable catalysts for future distribution growth, is a blue chip investment in U.S. energy infrastructure. So I want to thank you all for your support as clients over the years. We did celebrate an anniversary in July, so we appreciate your support over our firm's history, and look forward to working with you for many more years. So at that, I'll open it up to questions.
Sure, and I'm just going to give you a chance to submit your questions in the top left box while I scroll through some disclaimers here. While saying that, I noticed a few of you asked for a copy of the webinar slides, and if you would, please just request those by emailing info@yorkvillecapital.com, and we will ship those out to you. So just wait for a couple more questions to come in, and then we will get to them. So first question here relating to the MLP core income strategy: is this investment K1 free?
Okay. So Jim, why don't you kick off with, is this investment strategy, the MLP core income strategy, K1 free?
No. We have found that the greatest return you get in buying MLPs is to buy the underlying securities, and that's not to say that a fund is not a proper way to invest in MLPs, but we have just found that it's the most efficient way is to buy the actual securities, and we've also found that over the years the complaints about the K1s not being sent to you on a timely basis and by the way, Yorkville does not send out the K-1s. They come, and they actually don't come from the MLP itself. It's an outside entity that sends them out. But they've gotten very good over the years. So I think the last K-1 that I got probably was this year was I think probably early in March, if that was the latest.
Thanks, Jim. And I think
and you know what, let me just, before we go on from that, and one of the things that we've done in recognizing that the K-1s are a complexity of investing in MLPs, and one of my thesis is why the spread of 5% versus 3.5 and 3.8 for utilities and REITs is because of taxes, which is a wonderful thing. It means there's still opportunities in MLPs that haven't been arbitraged out of the asset class yet. What we do is there is a website called K1 Support where all of the K1s are produced electronically. We do publish this on our website so that as K1s are being made available, it is put out on our website. We also help our clients with K1 preparation. We publish this and we'll send this information directly to tax preparers. So we are working with our clients to simplify the K1 experience. As Jim said, there's no need to file for extensions with generally speaking, with MLPs. They're filed on a timely basis. They're available on time, even online, even faster. And we publish this information and get it directly to our clients' tax preparers to make it as seamless a process as possible. So, Will, there's next question.
And I think actually another question that just came through is a perfect segue there. What are the benefits then of investing in MLPs via different structures, whether that's an ETF or an ETN or SMAs? What makes sense for what kind of investor, et cetera?
Okay, I'll take a shot at this one. It's a good question because each structure has its advantages and disadvantages, and they do play into different accounts better. So we have published something on our website that does look at under YorkvilleCapital.com under the research tab. Will
under featured topics, I believe.
Under featured topics, there is something that does discuss different structures. So let me step back and besides talking about ETFs, ETNs, SMAs, or any of the fund structures, but more look at there's really three broad ways of gaining access to the MLPs. And Jim discussed earlier and what is direct exposure. And what direct exposure means is you're buying and investing directly in the underlying partnerships and you're receiving K1 income. So direct exposure is a very good way of and offers the best performance profile in the asset class on a total return basis. So the pros of direct exposure, investing directly in an MLP, best performance, the income that the partnerships produce on average is 80% tax deferred, not tax free, meaning that in a taxable account 80% of the income you will not have to pay taxes on until you sell the partnership. So it's a tax-free loan from the government as long as you hold the underlying partnership. And there's one positive nuance to that. If you hold the partnership for many, many years and pass away and it goes into your estate with a stepped-up cost basis, the recapture disappears, and at that point it actually becomes truly tax-free income. So the downside of direct exposure is the K1, so tax preparation becomes a little more complex and a little more costly because you do need to pay a tax preparer to do K1s. It's a little more work, so we like to say think at a cost per K1 of $50, maximum $100. So there will be additional cost to preparing your taxes, and then the other downside of the direct exposure, it produces something called unrelated business taxable income, which is produces something called UBIT. And so UBIT has interesting implications for both IRAs as well as tax-exempt entities, and I'll leave it at that. Sort of just dealing high-level pros and cons. So that's direct exposure. The second structure, and now we're looking at fund structures for these next two types of exposure. So for a fund to have direct exposure and invest in 100% MLPs, which so whether it's a mutual fund or an exchange-traded fund or a closed-end fund, if it wants to have 100% of its exposure in portfolio invested in MLPs, the IRS has said, okay, if you do that and you exceed more than 25% of your portfolio in MLPs, you need to become a tax-paying entity. So you have to file taxes as any other corporate entity. And so the downside to a fund that wants 100% MLP exposure is they end up having to pay a corporate income tax on the total returns that the fund generates. So it reduces the total return profile of the underlying assets because there's this 35% plus state and local 2 to 3% haircut taken on total returns. The benefit of a C Corp structure, it's pure MLP exposure. You're getting 100% of the portfolio is in MLPs, and one of the benefits of MLPs is this is a new asset class. This doesn't, when you add MLPs to a portfolio, it has low correlations to equities, to commodities, to fixed income, so it offers a tremendous diversification benefit. So a fund that has 100% exposure to MLP offers wonderful diversification benefits, and also the income that the fund produces retains the underlying characteristics of the partnership. So a lot of the income that these C Corp structures produce will be tax advantaged income. So it makes the C Corp structure, whether it's an ETF, a mutual fund, or a closed-end fund, ultimately good in a taxable account, again, because of the income stream it produces. The final structure, again, it's related to funds, is synthetic structure, and synthetic is basically swap structure. So the benefit there is that, like direct exposure, synthetic exposure delivers 100% of the returns of the underlying asset class. There's no there's no tax drag, so there's no 35% tax taken plus state and local 2 to 3% on synthetic exposure. So that's positive. It's a return profile that's very similar to what you would get from direct exposure. The downsides of synthetic exposure, one is you're picking up credit risk, so which you don't get in either direct exposure or the C Corp, and the income that and ultimately synthetic exposure is available basically through exchange-traded notes, is treated as interest income, so it's taxable when it comes off. So ETMs are given the return profile, and the taxable income are very good for IRA accounts where taxable income doesn't matter. So direct exposure, available only through SMAs. Fund exposure, you can have either C Corp, which is 100% MLP exposure, or synthetic, which is tracks the underlying portfolio and is available through ETN. So those are your three structures. Please, for more information, go to our website or call us. We'd be happy to spend more time on it.
Sure. Another question came in here. Given the performance that we've seen since 2000, and actually even before that, out of the MLP asset class, aren't we due for reversion to the mean? And I'll just add on to that. On top of that, at some point here, rates are going to rise. Who knows when that's going to be? What effect will that have on MLP returns?
Okay. Well, why don't I take a break here? Len, Jim, what are your thoughts on performance and where it goes from here?
Well, let me just address the latter part of that question about rising interest rates. And we've done quite a bit of work on what happens in a rising interest rate environment. And we've gone back, and we're not the only ones. There are a number of, or several brokerage firms that follow MLPs, and they've done similar studies. And the study that we did, I think we looked at, it's 6 periods of rising interest rates. And of those 6 periods, going back to the mid-90s we went back, 5 of those periods, MLPs actually rose as interest rates rose. And I think that what some people miss in looking at MLPs and trying to say, well, in a rising interest rate environment, we know what happens to bonds, and therefore that should happen to MLPs. They should, as interest rates go up, MLP bonds go down. That's axiomatic, and therefore MLPs should go down. And I think the point that people miss is that some people that MLPs, if you pick the good ones, the ones that increase their distributions, this will bail you out over time. So I think comparing an MLP to a bond is a mistake. And bonds have a place in someone's portfolio, but do not look at an MLP as a bond substitute. As far as the getting back to the mean, a reversion to the mean, we just think that the picture now is so much clearer, and so much. Years ago, I would be asked, "What is the outlook for MLPs?" and I would generally say the outlook looks good. We just talked to this company. We just attended this conference, things. There's a lot of good stuff going on. Starting about 3 or 4 years ago, the energy picture has changed in this country, which is what the theme of this conference call is about: energy independence. And I think the outlook now is so much clearer and so much brighter that I think that it's going to be quite some time before we have what the question was, a reversion to the mean. Just because I think that the outlook is so bright for the energy industry in this country, and particularly for MLPs.
Thanks, Jim. Another question here, maybe Len, you could take this one. The Wall Street Journal reported yesterday a decreased use of utilities. What kind of impact will decreased energy demand have on MLPs?
Insignificant. And the reason I say that is even though utility usage has gone down on the margins and may even continue on the margins, the simple fact is the need for oil and gas and energy is enormous and growing when one looks out over the intermediate and long term. So the way I describe the MLPs in a simple-minded way is that these are the veins and arteries of the economic body of the United States of America. I think that the effect of the slight decrease in utility usage will be, as the lawyers love to say, de minimis.
Okay, thanks, Len. Another question here, pretty straightforward, but what is the ticker symbol for the Yorkville MLP core income strategy? And Darren, there is no ticker symbol. We offer the strategy in the form of separately managed accounts, which Darren went to a little bit more detail earlier. So,
I think that is the answer. So the MLP core income strategy, as I talked about earlier, of the 3 different forms, is available only in separately managed accounts. So that's how investors can access the the direct exposure to MLPs through and Yorkville's expertise at the same time. If you're interested in the MLP core income strategy, please contact us. It's available only in separately managed accounts at this point. So there is no ticker symbol.
At this point, it looks like there aren't any further questions, so Darren, back to you.
Thank you, Will. If there are any final questions that we have a burning desire to get out, we'd love to answer them before we wind up this call. I want to thank you again for your support over the years and for this current quarter. We will be speaking again at the in the fall and for another quarterly update. And if there are any questions between now and then, or you want to speak to us directly about accessing our expertise in the asset class, we'd love to have that conversation with you. There's a lot of information on our website at www.yorkvillecapital.com. But we always love to talk to you in person, so please feel free to call in, and we're available. So make it a great day, and thank you for participating.